to the new changes. So we are asking, what is the current and applicable VAT tax rates? How many personal income tax bands have we seen in the past 1 year? Considering we are heading towards the end of January, since January 2020 to January 2021, how many tax changes in the charging for PAYE have we seen? And if you are aware how many they've been, then which of those tax bands gives us the most tax advantages as individuals? Which one makes us pay the least taxes? Is it the one we had? Is it the one we currently have? And how many are they? Then lastly, we are asking, what is the minimum tax and when is this payable? I will pause for a minute even as we try to pick out from the participants any thoughts they are having. I'll request Calvins to try help us see this, to try manage the comment section. So Calvins, please.
Yes, so I'll be checking the comment section, CPJ, and as well as the participant tab to see any hand that is raised for a reaction in for any of the questions that you've highlighted above. So participants, feel free to raise your hand so that I can cue you in to at least give a reaction to any of the questions that is now. Yes, I can see one of the participants already raised the hand. So Samuel Mumbere, please.
Yeah, I guess the current rate of VAT applicable is 16%. You can hear me?
Yes, Samuel.
Yeah, 16% VAT.
Thank you very much. So Samuel says the current VAT rate applicable is 16%. I tend to agree, but then we'll also learn from the presenter in case there are changes that we may not be aware of. So then, thank you so much, Samuel. I want to see if there's any hand that is raised. Anyone else who wants to react? You can react to as many of the questions, not necessarily just one.
Joy, your hand is up.
Share the comments.
Yes.
Yes. I want to react to the second question. I think the personal income tax bands that we've seen, I'm guessing there are three. What we used to have before, then the reduction that was done after COVID, and now what we have currently. So my guess is three.
Yeah, so thank you for that reaction, Joy. Your hand is still up. I don't know if that shows interest in answering any other question. So anyone else who wants to react to any other question?
Can I have a go, Bana?
Yes, FCPA.
Yeah. To talk about the minimum tax, it will become clear after we go through the sessions. That minimum tax is 1% for all companies, including companies that are trading at a loss. So they will have some 1% tax to pay. As to when it is payable, from my understanding, it is going to be comparable to the installment tax. So it's payable quarterly, and that is you calculate for the quarter or for the period 1% of gross sales, or gross revenue, and they will compare that with the estimated installment tax, and you take whichever is higher. That is what you pay. That's my understanding at the moment.
Yeah, so CPJ, I believe you heard that, so that is going to form the basis of your explanation. FCPA, I think correctly states that the minimum tax is 1% of the gross revenue, and we are going to also see that through the presentation. So Lynette, just allow me, I saw Lynette Ngena's hand up. Please, Lynette, I would not wish to lock you out.
Okay, good afternoon, everyone.
Good afternoon.
On the tax benefit or other advantage to individuals, the previous bans, the four bans were advantageous to individuals compared to the current 3 bans. So that is now what is it as at from January this year.
Yeah, so thank you so much, Lynette. I believe there's no hand that is raised. If not, then I would be corrected. Neither are there any reactions in the chat box so far. So please remember to use the chat box for any of the reactions that you'd wish to say on the 3 questions that were raised here by CPA Jason, even as we continue. So CPAJ, just allow me to react to the last part of question 2. And I tend to take the minister by his word that the tax advantage that the tax band that gives us advantage to individuals is this last one, the 3 bands. But yet, of course, numbers don't lie, and it's something that I'm going to be interested to see throughout the presentation. So over to you again, CPAJ, if you can hear me.
Thank you very much for your participation, everyone. And I've received also a couple of notes, or people have commented by sending directly into my inbox. I can see, I think we had Protich who was also commenting, and we will be able to discuss many more as we proceed. So allow me to pick these. Now, COVID struck, and the first move that was made was on the 25th of March in the inaugural speech by the president, when he indicated that there was a need as a country and the executive of the country to move forward and cushion Kenyans from the hard times. If you remember, the presentation we had back then is we saw changes that were giving us advantages. VAT was reduced, the PAY brackets were reduced, the company corporate taxes were reduced, among other changes that were made. And since April, because most of those changes became effective April, we saw Kenyans at the individual level and at the corporate level paying taxes at the reduced rates that were given. Going forward and fast forward to 2020, as we approach the end of 2020, there was a need for the country to be able to track back and reevaluate the effect of the changes that had been made. And various studies have been shown, but many of the studies show that to the tune of 20 billion, that is the amount that the country lost as a result of the tax that it did not collect by virtue of having allowed us to pay the lower taxes. So then in late September, a committee was set up to try and evaluate and reconsider bringing back some of those taxes. That is where the development that finally led us to the tax law amendment number 2 of 2020, which was later published on the 24th of December that year. Some of the major taxes discussed today is the employment income taxes, corporate taxes, VAT, and of course the digital service tax, which is also a sort of a new tax that has been brought in. Remember, we talked about it late in the last presentation we did last year, but the regulation to govern how exactly it is to be implemented were not ready. So this has also been published, and we can now be able to implement the digital service tax. Now, the new tax rates replace those that were introduced back in April 2020. So if we said, or if it was said that you're going to pay taxes at 25% for corporate tax, at 14% for VAT, amongst others, then these new changes replace it, virtue of this Gazette notice that I started with in the very first slide. You can see the small picture on the left of that screen. So then let us dive deep and start with the main tax that I believe everybody is interested in, personal income taxes. Other people call this PAYE. This is the tax that eventually decides how much you actually take home from the amount your employer promised you or you agreed at. Remember, your employment contract is usually grossed up, which means your amounts are decided inclusive of the taxes that you're supposed to levy to the government. And at the end of every month before the payment is made, some calculations are done to result to the amounts that should be taken to the government. So then what amounts are these? Back then we saw that the applicable monthly personal relief was increased. It was initially 1408. This amount increased to 2,400 per month, an equivalent of 28,800 every year. This was passed way back in April, and the amount has still continues to apply. The relief rate still remains to be 2,400 per month or 28,800 every year. Now, also the income that accrues through a digital marketplace. Any incomes that you will earn through services or goods or any engagements on digital platforms are going to forward be charged to tax, which is the tax we are calling digital service tax. And we are going to discuss it towards the tail end of this presentation. Persons earning up to 24,000 in a month are still exempted from paying taxes, just like they were towards at the start of April last year. So that continues to which means then the first PAYE bracket still remains to be 24,000 per month. Resident tax rates, though, was proposed in the bill to go to the upper rate of 30% in the bill. Realize that before we create any tax adjustments, a bill is first proposed, taken to Parliament for deliberations, then they adjust and give the final verdict, which is now what forms the Act. In the proposal, there was the need to take the upper tax bracket back to 30%, and it was passed as such. So the upper bracket, remember back in 2020, the upper bracket was reduced from 30 to 25%. We all remember that PAYE is usually calculated on the graduated scale, which is usually 10, 15, 25, 10, 15, 20, 25, and 30. In April, the 30% rate was done away with, but it has now been introduced. But that is not the only change. The 15 and 20% bracket rates have also been removed. So now, other than our salaries being subjected to the 5 scale, which is 5, 10, 15, 20, and 25, and 30, it is now subjected only to 10, 25, and 30. Your salary is no longer being subjected to the 15 and 20% brackets as we've always been used to, or to the 10, 15, 20, 25, as we became used to last year in the COVID relief package that the president delivered to us. So then how does this work out? I believe you're asking. So here it is. I've done an effort to just show you what the previous tax band, and when I mean previous I mean the COVID duration tax bands, the one that was given to us starting April, and the current tax band that becomes effective to the March you've earned working in January. These new tax rates became effective 1st of January, which means your salary since you started this year to the time you finish January is going to be subjected to the lower bands, as you can see them down there. Now, initially we had the 5 bands on the rates I've indicated, 10, 15, 20, 25. The tax brackets were expanded. You see the first tax bracket was 24,000. That has been maintained, but the 15 and 20% tax brackets have been released. Instead, we have 10, 25, and 30. What happens again is the second tax bracket has been shrunk further. Initially, it was 16,667, but now it has been reduced to 8,333. And then, of course, the last bracket at 30% works like that. But I thought showing this might not exactly indicate how it works. So to be able to answer Calvin's, who, for instance, indicated that the latest bracket gives us the tax advantage, I am glad to concur with the lady that indicated we've had 3 tax rates in the last one, the 3 tax brackets in the last 1 year, because when we started the year 2020, we had the previous tax brackets which had 5 rates. Then in April, we adjusted them to what you can see, what I'm currently calling previous tax bands. Then starting January, we are now working on what is below, which we are calling current tax bands. But the tax bracket or the tax calculation that gave us the most advantage tax-wise is the COVID period taxes, which is what I'm currently in the screen calling previous tax bands. That is the one that gave us the most advantage as to savings that we didn't need to pay as taxes. And I've taken some time to just do some calculation. So I'm assuming you are earning the amount I've indicated up there. So I just picked some tentative figures, and I imagined, let's assume you are earning 100,000 in those 3 durations. January of 2020, April, May of 2020, and January of 2021. If that is you, then what happens is on the far, allow me to just try locate my pointer. So maybe it might be easy to show you what I'm indicating to. So my pointer should be here. So if we were in January 2020, then your 100,000 will be distributed as I'm indicating here. Are we able to see my pointer? Ojuka, would you please confirm if you can see my pointer?
Yes, I can see the cursor.
Oh, you can see the cursor. That would be nice. So if you are earning 100,000, then what happens is your income will be distributed in the 5 tax bands like we indicated. And what you have, I'm calling currently charge, is the amount of tax you'd pay for each band in which your tax falls in. Then on the right of each segmentation is the tax that actually becomes due, having considered it with the percentage that you are supposed to pay. Then at the tail end, you see for your 100,000 in January of 2020, you would have paid, having considered the relief, 22,654 as your tax for that period. Starting April, after the presidential declaration reducing the taxes, for the same amount, 100,000, you would have paid total tax of 16,499. Then starting January this year, if you are still earning your very beautiful 100,000 shillings, you would be paying taxes worth 22,383. When you consider the taxes you'll be paying this year, January, and the taxes you would have been paying last year, January, you are actually paying just about 120 something less than you'd have paid last year. And a difference of close to 6,000 of what we were paying in the COVID relief period, where we were paying the reduced tax rates rather. So you can see the period that gave us the most advantage is the middle period, which we're calling the COVID relief period, because that is where we paid the least tax for the same amount of income. And just for clarification, I've also done the same calculation, but for a different amount. So for the second case, I'm assuming then, let us assume then you are earning 50,000, not 100,000. The first example, I did it assuming we were earning 100,000. For the second case, let us assume you're earning 50,000 in those 3 durations again. You will realize that pre-COVID, you would have paid taxes total 7,654. In the relief cushion period, you would have paid taxes of only 4,366 for the 50,000 you're earning. And currently, starting this year, if you are still earning the 50,000, you will be expected to pay 7,383. Again, the during COVID period gives us the most relief because we would have paid far much less than we would be paying now, as opposed to the current period, which more or less goes back to what we would have been paying back then. I want to pause there for a minute and see if we could be having any question as to how we arrived at the calculation or any other questions that relate to PAYE. And as you can see, the relief period, the relief amount for both during COVID and post-COVID remains as 2,400. The only relief that is different is the one we had pre-COVID, which was 1408. Allow me to pause there for a minute and see if you have any questions concerning PAYE.
Yeah, Jason, we already have a question in the chat box. And Monica Waga just wants you to, if you calculate the tax for NGO where pension is provided and pension is above 20K per month.
Now, Monica, what happens is when you have pension, pension usually is tax deductible. The amount of pension that you pay is tax deductible. Tax deductible should mean that if you are this person who was earning 100,000, I'm just trying to go back to my slide up here. So if you're this person who was earning 100,000 and you are paying pension of, let's say, 20,000, we would treat you, or we would treat your income as if you are earning 80,000. Why 80,000? Because the 20,000 will act as a cushion of the amount you don't pay taxes on. So on the 20,000, we'd less it from the amount you earn, then the amount that would be subjected to taxation would be 80,000. So basically, you'll be taking 80,000 and putting it in your balance, then calculating it as it trickles down on the other tax rates that we have. Though you should know that for pension, there's usually a maximum on whose relief you want to work with. We usually have something called excess pension, which is at 25,000 for every month. So if your contribution and the employer's contribution, if the total is more than 25,000 in a specific month, then any other thing that comes in above the 25,000 is treated as excess pension. And then in discussing excess pension, we want to ask ourselves, is the excess coming from the employer side or from the employee side? If it comes from your employer side, then it will be added back to your salary as a non-cash, the way we would do non-cash benefit transactions. So if you are earning 100,000, then the total contribution of your pension, let's say is 30,000, which means you have over-contributed by 5,000. If the 5,000 is attributable to your employer's contribution, then we would be assuming you're actually earning 105,000, then less the 25,000, which is your maximum pension, then on the difference we would subject you to taxation. But if the amount is less than the limit required, if the amount is different than the limit required, then we would want to just reduce it or deduct it and then proceed with the calculation. I hope that answers, was it Monica? Yes, that was Monica. But if there are any further questions, we can be able to try and get back to this. We'll be able to share my details at the tail end so we can have any side discussions, as we are also trying to keep within the time frame that we promised for this presentation. Having considered that, then I will seek to move to the next item. And of course, for pension withdrawals, it has been adjusted back. Remember when the PAYE rates were discussed, what happens is for pensions withdrawals, the rates were also reduced from the 5 rates. So the 30% rate was removed. It has now been brought back, considering the 30% rate has also been brought back in the taxation of PAYE. But this is pension withdrawals of amounts that are above the recommended or above the amount that we are allowed to seek out within. So, and I'm indicating down there that lump sum withdrawals from pension, you usually, the first 60,000 for each year that you worked as a pensionable staff is usually not subjected to taxation. So if you worked for, say, 10 years, then 60,000 for each year under which you are pensionable is usually not considered for taxation. But any amount you withdraw in the excess of that amount, we should be subjected to taxation at the rates we are indicating. And the reason why I'm highlighting 30% is it's because it's the rate that has now been brought back, considering the PAYE calculations have been adjusted back from the 4 bands which ended at 25 to now 30%. So not so much to discuss under pension. I will swiftly move to the next tax item, and that is VAT. VAT has not seen many changes. The only 2 areas that we need to talk about. The first one, of course, the VAT rate was moved from 16 to 14% in April. Starting 1st of January, it has been moved back to 16% from 14%, which means all the invoices you've been working on starting 1st of January should be indicating 16 and not 14%, which means the VAT returns you're going to file by the 20th of February, which relates to the transactions for January, should be organized on 16% and not 14%. That became effective on New Year. Now, so the first return is due in February, which relates to January. We've talked about that. The only other slight change that happened in VAT is Section 17.8 brought in something. You'll realize that we said in previous discussions that the government has often used taxes to try and promote or discourage some thoughts or policies that they have in mind. You must be aware that currently the government is keen on this line item or tag item they call Build Kenya, Buy Kenya, or is the other way around? You know about it, right? So the government has decided and said, and I'm just going to read, then be able to interpret that for you, that notwithstanding the provisions of this section, any registered person who is a manufacturer may make a deduction for input tax with respect to taxable supplies made on official aid-funded projects, as may be approved by the Cabinet Secretary from time to time within the first schedule. So basically, you all know that when you are doing VAT supplies to an NGO or to an official donor-aided organization like Red Cross, NDMA, you do not charge them VAT, often because they have a VAT exemption certificate. What happens going forward is if I am a manufacturer and I'm supplying ABC goods, let's say to the National Drought Management Authority, even with them having a tax exemption certificate, I am allowed to now charge them VAT, and it will be the business of the government to find a way of replenishing that amount from them, not from me. Normally, I would be, by virtue of the exemption certificate they have, I would not charge them VAT. But remember, in me providing those services, I was charged VAT. Always ended up in a position where I am claiming VAT refunds from KRA. Now, this is going to happen that for manufacturers, and to try to see that the cost of production reduces, because when this happens, then the manufacturers are able to quote their prices or put a price tag on their commodities that is fair in the market. Then this move is a welcome move for the manufacturing industry. Now, do not go forward charging exempted institutions VAT if you're not manufacturing. If you're a training firm that like Capable, this does not relate to you. We are only speaking of manufacturers. So if Red Cross is going to buy ABC from manufacturer C, then the manufacturer can decide to continue charging the VAT, of course, after seeking approval from the cabinet secretary, even as it goes in contradicting the section that gives them the express tax exemption. I hope that clarification is clear. So only for manufacturers that are supplying to exempted institutions, they can proceed to further tax VAT even in the presence of that exemption certificate, as long as the cabinet secretary has approved. Now, this is going to make them more competitive, and their prices are going to be more easy. Their prices are going to be easier to work with. What happened is, by this exemption made it easier for us to import rather than to manufacture, because it was easier to, it was somewhat cheaper to bring in products than to manufacture them, considering the cost of VAT that is involved in being able to come up with the full product through the manufacturing process. So again, that is a small other change that was done, but the major announcement in VAT is the rates have since moved back to 16% from the previous 14%. I'll ask that if you have any questions, we consolidate them to the tail end so that we do not have numerous breaks. I believe Calvin would agree with me on that. So then I'll move to the next tax item, which is corporation tax. Again, it was reduced to 25%. It has now been taken back to 30%. This rate was reduced to 25%. It has gone back to 30%. For income that relates to year 2021, this rate became effective on 1st of January 2021, which means only for the incomes that are attributed from January of 21 to the end of January. Incomes that are attributable to the back years are still chargeable 25%, which means the accountants and auditors might have a tough time this year trying to balance their books, as part of the income might be attributable to the previous year and previous rate of 25, and the incomes that are being generated starting January are at 30%, noting that this is only for resident companies. Non-resident companies, their rate was not touched. Please remember that rate remains at 37.5%. Again, having finished that, we go to the new tax introduction, which is minimum tax. It's actually not new in this act. It was introduced late in 2020. What was lacking is the regulation for implementation. How do we implement? That comes out clearly, and we're saying that minimum tax is a base tax. It's basically saying everybody needs to pay tax regardless of how they are performing. If you are performing well, you will be subjected to some taxes. If you do not perform, or if you make losses, like FCPA Francis rightly mentioned, you also should pay some taxes. Now, minimum tax will work hand in hand with what we currently know as installment taxes. Remember, installment taxes are usually payable on the 4th, 6th, 9th, and 12th months on the 20th days of those months. Or if it's an agricultural, if it's an agricultural setup or an agricultural institution, then it's the 8th and 12th months divided as 75% and 25%. Now, remember, you only pay installment taxes if you made profit in the previous year. which means if you made profit in the previous year, then you'd want to calculate 10% of the profit you made and consider it the profit of this year, divide it in 4 installments, which is the 4th, 6th, 9th, and 12th months. And I believe we had that discussion before. Now, if it happens that you made a loss last year, previously, you would not be paying any installment taxes because you are dividing 0 by 4. Now, KRA is saying that it is not fair that we are giving you an enabling environment, that the government is supporting your services, yet you do not pay any taxes simply because you didn't make profits. So what we're going to say is for those years that you do not make any profit, you are supposed to pay the base tax, the minimum tax. And the minimum tax will be 1% of the gross turnover. Remember, turnover is basically the sales that you make. So in a year of income that you decide, or the economy decide, or your customer decides, or your auditor decides, depends on how you decide. But normally you make losses because your revenues are less than your expenses, right? So in that year of income that you have, you made losses, you will actually need to pay 1% of the total sales that you made in that year, divided in the 4 months in which we pay installment taxes. So if your 1% of the total sales is, let's say, 100,000, that is assuming you made $1 million total turnover, then this 100,000, you should pay 25,000 on the April 20th, 25,000 in June 20th, in September, and in December 20th, on the very months that you pay your installment taxes. But for cases where you have made profit, then you do not pay installment taxes. You instead pay the installment tax. Now, if you read the Tax Amendment Act, it indicated that, I'm reading the last bullet, that where the installment tax liability is higher, what the Tax Amendment Act read is that if the installment tax is higher than 1% of the gross turnover, then you should pay the minimum tax. It has actually been corrected that if your installment tax is lower than the minimum tax, then you need to pay minimum tax. So if your installment tax would only be lower if you didn't make any profit. So just capping it up is if you make profit, if you make losses in any year of income, you will need to pay taxes, corporate taxes, or installment taxes to the equivalent of 1% of the amount of turnover that you made in that year of income. I hope somebody followed through. If there are questions, I'll be glad to pick them as we finish. But minimum tax does not apply to everybody or to every institution. There are some exemptions, and I'm reading those. Number one, it is if the income, the exemptions is one, where this income is exempt from tax under Income Tax Act, which means if as an institution, you have been exempted from paying income tax, then you don't pay minimum tax. It is not subjected to employment taxes. So please, FCPA, do not go paying minimum tax on your salary. It's only for corporates. Persons paying residential rental income taxes are not subjected to minimum tax. Any person who pays turnover tax, where the capital gains has already been paid, remember capital gains is usually an advance tax. When it has been paid, you don't pay minimum tax on that. And lastly, any taxes that are due and payable from mining and petroleum activities, it is still in the keen interest of the government to promote mining and petroleum exploration. So for those activities also, minimum tax is not available. Now, those are the provisions that were given in the Tax Amendment Act, the first one. Now, the second amendment has actually just done by adding 2 additional tax exemptions to minimum tax, which is the last bullet. So the Amendment Number 2 Act further exempted persons engaged in business whose retail price is controlled by the government. So if as an institution, your retail price is controlled by the government, the amount of value you charge your goods or services is controlled by the government, you've been exempted, virtue of the Tax Amendments Act Number 2, and any person who is engaged in insurance business has also gotten an express exemption from paying minimum tax exemptions. So again, just recapping that slide, the Tax Amendment Act Number 2, the one we're discussing, has only added the last 2 exemptions. The first 6 exemptions up there were actually present in the first amendment that we had last year. I move to, I think, more or less the last tax we should be discussing today, and that is digital service tax. Now, digital service tax is what I would now call the new tax that has been brought in. It was proposed last year. It was actually proposed way back in, I think, 2013 2015 or thereabout, but we've never had quite the framework as to how to implement it. Digital tax would be Kina Jumia and all these other, online platforms. So to help you really know what digital service tax is or what it caters about, then in the definition of the Act, a digital service is any service that is delivered or provided over a digital marketplace or market platform. A service that is delivered or provided over a digital marketplace or over digital platforms. It further defines a platform as any means which is electronic in nature that allows those digital services to be connected to the users of the services, either directly or indirectly, and includes sales of a website and mobile applications. I'm just reading that slowly so you are able to try scoping the kind of activities that you do and see if they actually might fall into some of these categories. Now, digital service tax shall be imposed on the gross transaction value of the digital service being anything that falls within the definition above, which shall be the gross transaction value. Number one, in the case of provision of digital services, then the payment that is received, the amount that is paid for that digital service will be the gross transaction value. And if it is the case of a digital market space, if I do website hosting, then it will be the commission or fee that is paid for me providing the digital market space. Now, digital services come in two ways. I can be the person who makes my services or goods available over digital platforms, or I can be the person who provides the platform upon which people come to put on their services. I hope you get that. So if you are the person who sells your goods or services over digital platforms, then the gross transaction value will be the amount that you charge for those goods or services. If I am the person who provides this digital market space, if I'm the person who does website hosting, for instance, then it will be the fees or commission that I charge people for being able to transact on my platform. You get the difference? Now, the gross turnover for digital service shall not include the VAT charge for that service. Remember, VAT charge is a separate tax and it has nothing to do with digital service tax. So we're saying that the gross transaction shall not include, my apologies, shall not include the value of VAT to that regard. Just to quickly try and narrow down some of the services picked within the digital service tax, there's a long list there. So is it downloadable content? So you're selling music, you're selling ebooks, you're selling films, you are Netflix as operating in Kenya, then that is a digital service. Over-the-top services, including streaming television shows, videos, Viusasa, podcast. I'm just trying to pick examples that are relevant in our capacity as Kenyans. Sale of, licensing of, or any other form of monetizing data collected about Kenyan users. You are a content creator on YouTube. You ask people to subscribe to my channel and then YouTube pays you. That's a digital service. Any provision of a digital market space. I am Jumia and I'm telling all the suppliers, you can come on Jumia, you can advertise. When you sell, I'll take this commission. I'm providing a digital service. Subscription-based media, including news, magazines, journals. I know that NTV, I know that the Nation newspaper, you can access it online at, I think, 20 shillings. That's a digital service. Electronic booking or electronic ticketing services, including online sales of JumboJet tickets, KQ, and any other service, as long as it operates in Kenya. Now, we are going to further define how we determine if it's actually in Kenya or not. Provision of search engine and automated help desk services, including supply of customized search engine services. I believe one or two people have ever reached out to your company asking you to do SEO, search engine optimization, and that kind of things, digital services. Online distance training through pre-recorded media or e-learning, including online courses and training. If Capable decides to charge this Zoom call today, digital service. If you are in Nairobi University and they're charging you for e-portals, digital services, among others. There are some exemptions though. Online services which facilitate payments, lending, or trading of financial instruments, commodities, or foreign exchange, as long as they are carried out by a financial institution such as Equity, a financial service provider authorized or approved by the central bank, such as Centum, online services that are provided by government institutions such as, what is the name of this place we go to book our driving tests and everything? eCitizen. Those have been exempted, much as they clearly fall within the scope of digital services, they have been exempted from the digital service tax. So all banks, so if you're doing your online banking, as long as it's on a digital platform, it has been exempted because there's a requisite tax that falls within that category. Companies that help you to manage your shares, stock, options, bonus, and stuff like that have been exempted because they are regulated by the central bank and other government regulatory organs, and any online services provided by the government institutions. If you're a member of Nairobi County and the county has decided to bring in the online parking and payment system, that is exempted because it's a government service. I know the one question you're asking is, I'm consuming services from Amazon, and Amazon is not in Kenya or is not owned in Kenya. So what is the scope? At what point do we pay or charge or contribute to this digital service? Because as opposed to different corporations which are domiciled in the boundaries of a country, online services could be anywhere. I know companies that have their website hosted outside of Kenya. How then does this contribute? So I took a slide to just show you where that, and I'll be showing that in the next slide. But for starters, digital service tax shall be paid by the digital service provider or digital market space provider. Allow me to just fix in my charger. Thank you very much. The digital service provider or digital marketplace provider, or the tax representative, if at all you have a tax, or you have appointed a tax representative to help you pay your taxes. Now, DST is not a final tax. DST is not a final tax. DST is just the same way we usually pay installment taxes. So DST will be offset against the tax that is due from you at the end of the year. So if Capable, for some year, they have some DST that they have paid out, when they're doing the final end of year company tax computation, they will actually consider and offset the amount of DST that they paid in the course of that year. So it is not a final tax. It is only a final tax if it is paid by a non-resident person who do not have a permanent establishment in Kenya. It is only final tax if it is paid by a non-resident person who does not have a permanent establishment in Kenya. If you are a resident, or if you are a non-resident but you have a permanent establishment, then DST becomes a tax that you can offset when you're doing your final returns at the end of the income period. For purposes of charging DST then, we consider this service to have been consumed in Kenya if A, the user, that is you consuming, receives the digital service from a terminal located in Kenya, where terminal includes a computer, a tablet, or a mobile phone. Okay, so if you're going to consume Netflix services, much as we know Netflix is not Kenya owned at any point, then we are going to tell you to, we are going to ask that Netflix pays us the digital service tax for that for the amount of transactions you've engaged in, because you have decided to consume it while you are in our boundaries. Number two, when the payment of the digital service is made using a debit or credit facility provided by a financial institution or company located here. So if you are a Mzungu, but you decided to pay for your services, which is not in Kenya, but you decide to process your transaction through Equity, then please pay digital service tax. The digital service is acquired through an internet protocol address, IP address. For those who have a little IT knowledge, you will know what IP address is. IP address is the track to the portal that you use to access internet. So the digital service is acquired through an internet protocol address registered in Kenya or an international mobile phone country whose code has been assigned to Kenya. So if you use a Kenyan IP address, hata ukiwa pale nje, please remember to pay our digital service tax. And lastly, if the user has a business, residential or billing address in Kenya. So you are operating in Malaysia, but for some reason we find out that you have a business address in Kenya, then we shall be glad to collect our digital service tax from you wherever you are out there. So that is basically how digital service tax is meant to operate. And in finishing, I'm just putting it here, the notice that KRA gave or concerning the various tax changes that we have been discussing now. And at that point, I'll be glad to indicate that I've been able to cover in 45 minutes the tax changes that we hoped to cover in the course of this Zoom presentation. So then I'll pass the baton back to Calvin to help us moderate the Q&A session. Thank you very much.
So thank you so much, Jason. And thank you so much, the participant, for sitting through the presentation. I was able to pick a few concerns in the chat box that I'm just going to read to you, Jason, and we are going to try to address. Afterwards, I'm going to see if any of us shall have raised their hands to ask any question concerning the presentation that we had for now. So the very first question that I have for you from the chat box is just give me a minute. So I believe we tried to address the question that Monica raised concerning calculation of the NGOs where pension is provided, and we said we would talk further if there is any question that involves that directly was not understood from this presentation. So, Jason, I think there was a concern that you was sent to my inbox, and you could address it.
All right.
That sure. I believe there is a difference in tax calculation for corporate and NGOs.
In this regard, I want to believe we are talking about corporation tax. If it's corporation tax, then many a times NGOs are exempted from paying corporation tax, so that should be different. Yes, but if it's the persons working in the NGOs, which is, we now go back to PAYE, then if they are not expatriates, then they pay taxes as every other Kenyan does. Thank you. I can just pick it from there. I can see more comments on my chat box as well. I think Monica again is asking, can you claim the loss of minimum tax as an expense? You cannot claim taxes as an expense, Monica. What we are saying is, if in a year of income you made losses, which means you are not due to pay installment taxes in the following year, you will pay 1% of your turnover. And I want to tie that with the question Collins Nam is asking, that let's take, for example, you made a loss in 2020, and by that you are not liable to pay installment tax. Very correct up to that point. Then what turnover will be used to assess the minimum tax you pay, for example, on February 20th? No, it's on the April. It's 4th, 6th, 9th, and 12th months, not February. But still, turnover is the total sales. Turnover is not profit, turnover is total sales. So Mr. Collins, you take 1% of your total sales, you pay that as minimum tax. So you divide whatever amount you get as 1% of the total sales you made in that year that you made losses, divide it by 4, assuming you are not an agricultural sector institution, you pay it in the 4th, 6th, 9th, and 12th months. But if you are working in an agricultural institution, their installment taxes are 2, not 4. In the 8th month, you pay 75% of 1% of the turnover. In the 12th month, you pay 25%, not unless you have the express permission of the Minister or Commission of Domestic Taxes to pay in other forms. I believe that answers both Monica and Collins. Jane is asking, what about non-profit making corporations? Again, NGOs are exempted from paying corporation tax, by extension, exempted from paying the minimum tax. Thanks, team. Keep the questions. Oh, that is a comment. For digital tax, can you explain with the example of Uber service? We have the Uber company, the driver, the passenger who is liable to pay the digital tax, withholding tax. Now, tax is paid by the person who should pay tax is the person who is paid. Is more or less like withholding taxes. So at the point where I am paying for my services, the charge that will come to me will include the DST. So I will pay the full amount to Uber. Then Uber are supposed to, on the amount the accumulated of DST, remit it to KRA. Otherwise, they will have problems with the operations in the country. So what will happen is, in the amount you will pay for these online services, we are actually anticipating that going forward, the cost of accessing our online services, which is what largely forms digital service tax, is going to increase slightly, in considering that many service providers often shift the cost of taxes to the consumer rather than cushion it themselves. So we're going to see a small rise for those people who have been paying Netflix, blah, blah, blah. We are anticipating a slight change in the prices as the service providers tend to push that cost back to you. Please share with me the presentations. They will be shared, Mr. Hillary. Kenyans are overtaxed. Well, what do we say? I believe I've picked all the comments that I found in my chat box, not unless there are others directly sent to Calvin's, then I'll be glad to listen to them.
I suggestion I can confirm you managed to pick through all the questions that were raised by the participants. I just want to give an opportunity for a few more people to ask questions directly to the participants. And also to find out from Monica, Collins, and Jane if the questions were answered as they expected. So Monica, Jane, and Collins, you may confirm for me that in the chat box. But for now, let me see anyone who's raised their hands or to have a specific question that our presenter can address at the moment. So I'm going through the chat, the participants, and I'm seeing Monica is raised the hand. So Monica, please. Monica, if you can hear me, please just proceed.
Should see Monica is having connectivity issues.
Yeah, it seems so. So then, while Monica is still trying to reconnect, anyone else who?
Okay, can you hear me now?
Yes, Monica, I can.
Yeah. So the reason why I said there's a difference between pay as you earn for NGOs and corporates is because NGOs do not pay the corporation tax. So because they don't pay the corporation tax, when the employer contributes to pension, any amount that's above 20,000 is normally loaded onto the employee as a benefit. So the calculation that you had given, the one of 100,000 minus 20,000, probably if it was like 30,000, let's say the pension contribution was 30,000, 20,000 would be exempt, but then the 10,000 would be loaded onto the employee, so that now the employee would be paying 100,000 plus 10,000. The taxable amount would be 110,000.
Monica, thank you for your comments. And basically what you're discussing is what we call excess pension, which actually works all across the board. There is the maximum limit of pension that is deductible from your pay, giving you the tax incentive that the government intended your contribution to pension to give. So what will happen is, even for people not in the NGO sector, if you contributed more than the maximum limit is 25,000. So if you contribute more than 25,000, the total contribution of employer plus employee, if your total contribution is more than 25,000, like I tried to indicate, so let's talk with the 30,000 you mentioned. So if the total contribution is 30,000, if it so happens that the excess, the amount above 24,000 is attributable to the amount the employer gave, then it is loaded back to the employee as a benefit, then taxed on it. But if the excess is attributable to the employee, then it is simply not taxed. It's just as if you've gone to Java and eaten 5,000. So they just treat it as an expense. They don't give you an incentive on it. The only difference is if it is attributed to the employer, it is added back to your salary, the individual salary, as a tax, as a non-cash benefit. That's why I gave that example. It's loaded back to your salary the way you're indicating, then you are taxed on that amount. So if you're earning 100,000, then the excess is 10,000, you'd be taxed on 110. So that I can confirm, Monica, does not only happen for NGOs, it actually happens all across the board. Thank you very much. Thank you very much. I hope we have gotten to a consensus on that. If you not, we can just try and go back. I can see a good question here from my good friend, Movin. Movin is asking, what of the common online writing? Now, this is actually a discussion, and if I can mention, this is actually one of the reasons why digital service taxes was introduced. There was a news story, I think about 4 or 5 years ago, of university students who drive big cars with no clear indication of where they are deriving their incomes from. and the discussion later generated into them doing this item we call online writing, which has not been documented anywhere by any government, because for starters, it is quote unquote illegal. So for this one, it's within the confines of digital service tax, it should be taxed under DST. But the problem is we do not have the documentation, we do not have the trace or trail of knowing how it operates or how much actually comes through these portals. But you going forward, you will be taxed on the amount that you receive, let's say through PayPal, because now PayPal is a corporation that has structures and systems, and it will be easy to know how much you are paid through PayPal. So if you process your transactions through PayPal, as long as you've accessed PayPal through a terminal in Kenya, and we say the terminal in Kenya is your computer, your laptop, your mobile, then on the amount that is coming through that, you will be taxed. But on the transaction you are having with your client, I think we still do not have clear structures to be able to trace that, but the government probably, I'm not sure, might be having a workaround or might be slowly trying to find a way to be able to track and bring that into book. I believe that answers my good friend Movin. I see he's further indicating that PayPal can come as a gift. Well, but you will have accessed it through a digital platform. Remember, if we decided to give you a gift monthly into your account, KRA might actually decide to say that is income you're receiving and decide to tax it as well. So still chargeable under digital services tax. Thank you very much, Movin. Calvins, if there is no other question, then I want to believe that will be it for me.
Yeah, so thank you, Jay. Monica's hand is still up. I don't know if Monica, you have another question or you failed to lower it after you asked the first question.
No, Samuel Mumbere sent a question to me privately. If he's here, let him ask the question, because he was asking, how does digital service tax sync with the VAT Act, which exempts education basically?
Thank you, Monica. I'll just answer this question by going to a slide that I had back here. Please read the last bullet. The gross transaction value of a digital service shall not in any way include the value tax charged for the service. Okay. Just the same way professional services, we charge VAT, then we charge, for instance, withholding taxes, all separate. On the net amount does not include VAT. So when we're discussing DST, let us not talk about VAT. They are all independent. You only don't charge DST if the list of exemption that I gave here, or rather here, if your digital service falls in this exemption, that is what is excluded. And of course, if you have any question or if you're operating in an environment that is not as clear or on whose groundings you can't find a direct answer, we can always seek answers through the Commission of Domestic Taxes or through many other avenues, including talking to our consultants like the one speaking currently. Thank you.
Yeah, thanks, Jay. There was another question that came in from Esther. So Esther is asking, on minimum tax, what will happen to companies whose financial year does not end by December 31st? Are they still expected to pay first installment by 20th April?
Now, for this case, you will pay, I believe you're asking about minimum tax, and I indicated that minimum tax is payable in the same era in which we usually pay installment taxes. So you will pay, your minimum tax will be due at the very point your installment taxes are always due. Your income tax, your minimum tax will be due at the very point you usually pay your installment taxes. And I can see lastly, FCPA is asking for the rate for DST. Now the Act is interestingly very silent on the rate for DST. I think I've combed around, and even if you try to go online or even on the LSK website, you will not even get a copy of the current the document we're discussing, the Tax Amendment Act number 2. So the law is quite silent on what rate exactly is applicable, but in the common interpretation is considering they've said it is you can decide to, you will charge it or on the cost of transactions. We can work, the rate has not expressly been given, but considering it has been it is levied on the cost of services, I think as more details come in, we can be able to try and seek out. But as it is, what the common interpretation is, people are working with the VAT rate for DST. But that clarification, as soon as we get it, we'll be able to communicate it as soon as probably when we're sharing the materials or any other time that comes sooner. Because if you look at the, I think I have a KRA snip out here. No, it has not been indicated here as well. Actually, the snip out here does not talk about DST for starters. It only talks about VAT, minimum corporation tax. But I'll be able to try and find out the exact rate that is intended. But currently, as it is, it only gives the proposal as is. I don't know if that comes out.
Yeah, thanks. That's a good answer.
So Calvin's, then
Yeah,
I think
thanks,
I'll get back to you.
Yeah, thanks, Jay. I tended to see Mary Ngile had a hand was up. It's lowered now. I don't know if she has a question she just raised, but Monica's hand is still up. Monica, any question? Okay, that has been lowered too. I also don't seem to find any other comments in the chat box, and therefore I want to believe that we try to. Oh, there's one more message arriving. Okay, therefore I believe we try to address the areas of your utmost concerns, dear participants. Allow me to bring an end to this presentation, and even before I usher in our very able host, who will also welcome a vote of thanks that will give us further direction. Allow me just to reiterate what was said by Monica, that Kenyans are being overtaxed. So even up to there, I just want to proceed by saying, do not miss out an opportunity to interact with us on other events, our other tax events coming. Yes, someone is talking.
Just 1 minute to interject.
Okay.
The digital service tax is 1.5% of the transaction value. Sorry for that. The digital service tax is 1.5% of the transaction value. 1.5% of the transaction value.
Okay. So thank you, Jay. I don't know if that is now well understood by FCPA Francis and the participants. FCPA Francis?
Yes, I am satisfied. I thought I had seen it somewhere and I was forgetting. But actually, I told my colleague it should be 1.5. So
okay.
It's confirmed. Thank you so much.
Yeah, thank you so much. So like I was saying, please, ignorance will not be treated as a defense in matters taxation. So do not miss out an opportunity to interact with us further on our tax events. Coming up shortly will be the very one coming closest to today is 1st February of this 2021. So do not miss out to consult us, to register, and we'll surely be there to assist you in anything that you need matters taxation. So up to there, allow me just to welcome our able host today, Mr. Simon Mwachi. Simon Mwachi will take us through any lessons, including ushering in vote of thanks from our dearest of the participants. So thank you so much, and over to you, Simon Mwachi.
Okay, thank you so much, especially to CPA Jason. You have really done the presentation very well. And of course, you have also engaged our delegates very well, answering almost all of their concerns. And I believe at this moment, there is no one else who has been left out. If you have something that you still need clarification kindly the chat box, or you can also just raise your hand. I can see we have close to 8 minutes before we end our session, which is always timed at an hour and a half, so that we are back to our possible schedules by 1:30 p.m. But before that, I would like to give thanks to all of us who have spared time and sacrificed to be part of this presentation, so that we can enhance our knowledge in matters tax, and so that we can know how to serve our organizations and the society in general better. And so I really appreciate that. And on behalf of Capable, we are really grateful for your trust in our services. And also, of course, I also want to thank Calvins for actively engaging all the delegates. And also I want to thank the delegates for opening up and giving thoughts, concerns that have been addressed effectively. Now, at this moment, I would like to just give us a very quick reminder. We have started 2021 with the best energy as expected. And it has been really good to see that we have clocked almost 48 attendees in this session. We actually have our calendar for free webinars ready. We also have our calendar for the main CPD events ready. And if you can just see my screen, I'm just sharing a section of a page from our corporate website, the Capable website, for those who frequently visit to just check what we have in store. We are grateful for that, and we hope that you will find a topic or two that interests you and your organization and your colleagues, and you will, of course, give us a call or mail us so that we can see how best to register you and have you and your team attend the said event. And if you feel like you need a topic or an area that you need to be trained on with you or with your colleagues, and you can't see it on our online calendar or in our copy of the calendar, also feel free to share with us the topic. What we do is we will take the topic, we'll then gather our professional trainers around the same and come up with a program that is fully customized to see to it that we deliver what you expect. And then we can go ahead and have the same event take place either as an in-house training or as a virtual training program, or we attend venues like, let's say in Sarova, a 1 week training or a 2 week training. So with that in mind, kindly constantly check our website and look at what we have in store and the events that are coming up. And on that note, I've also shared the link to our next free webinar, which is taking place next Wednesday. If you are not yet registered, kindly click the link and then register for the same. I will be, of course, working on the certificates, which are quite a number. And I beg your pardon for the delays that we have had for the previous certificates, but I want you to have my word that you will have all the certificates as soon as possible. With that note, I would like to bring the session to an end, and I will give an opportunity to 1 or 2 people, maybe the delegates, to share any general concerns. If anything that is not necessarily part of the presentation today, any comments or closing remarks, anyone? You can just raise your hand and then say something. Or if you have joined us for the first time, you have never been part of our webinars and you would like clarifications on 1 or 2 things, you can also speak up and then we can have your issue addressed. Yes, anyone? Trying to see if someone's hand is up. All right. So seemingly we are all well set and everything is as good as we expect it to be. So, okay, someone has sent something in the chat box. FCPA reminds me to share the certificates, of course, plus this one. Okay, I will be working on that immediately after this. And of course, I'll also share the recording for the event so that even those who have missed out will be in a position to find time and listen to this presentation. So thank you, everyone. I will end the session. I will make a very short prayer and then we will disperse and work on our other personal schedules that are awaiting us for the afternoon. So let's humble for a very short word of prayer, and then we can disperse. So let us pray. Almighty Father, it has been a wonderful day. We have started the year very well, and this is our first session on our series of free webinars. And as Capable, we are grateful, and we are even more grateful for the delegates who have their trust in us and always sacrificing their time to come and be part of these knowledge sharing and value-packed sessions. How I pray that you continue strengthening all our delegates and all the companies that believe in our services. How I pray that they be able to develop themselves and expand their service ability to the society. I in a special way want to also thank our trainer for today. I pray that you bless him more abundantly and that you enable him continue sharing and impacting lives of professionals wherever he goes. I also pray on behalf of Capable as a company that you continue giving us the ability to innovate, to simplify, to improve, and to come up with products that actually work and serve the needs of all our clients. And with that short prayer, I want to thank you through Christ's name, praying and believing. Amen. So thank you so much, everyone. Always feel free to reach out to me or give us an email or a text whenever you want to communicate to us on matters knowledge development, and we will always be there to serve you. So thank you so much, and we are free to disperse.
Kuna pepa zenye niwe hizi nitumie kudraft hizi zote bwana, uache mchezo hii sasa. Sio unaona ile alipiga iko haribika hadi huko si kwa si nilikuwa hapa not with that and not away sinatumia kwa kidogo ni check kidogo tulikuwa na nimemaliza